Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. The US Federal Reserve hikes rates for the third time this year, looks set to take rates to 2.5% by the end of 2018. The Indian government hikes customs duty on 19 products in a bid to bring down the trade gap and aid the currency. The government is forced to extend the subscription period and cut the issue price for the Garden Reach Shipbuilders IPO after it received a tepid response in the first 3 days. State Bank of India will make 480 crores by selling 4% stake in SBI General Insurance to an alternative investment fund prompted by Axis and Premji Investment. Well, it's a mixed start to the trading day today for our markets. But first, the global news roundup, and we'll get in expert voices as well. But here's what's happened on FOMC. The Federal Reserve has hiked rates on expected lines by 25 basis points, and they've kept the range in the range of 2.2 to 2.25. The key thing is that they have dropped the accommodative word from the policy. However, Jerome Powell was quick to add in the press meet that this is not a policy signal. Almost all counts seem to suggest that going ahead, by the end of 2018, we'll have one more rate hike in the offing. The strong economy will warrant one more rate hike. This is something that the Fed officials and various officials have affirmed as well. So what's happened shouldn't be a surprise. What will happen in all probability shouldn't be a surprise if it is just one rate hike that we'll get from the US. Now, what that did to the US markets, precious little, to be honest. I'm just look at the Dow, S&P or the Nasdaq, very, very flattish moves. What's happening on the Asian markets too? Well, actually flattish moves all around. So because there was no surprise and all the news was baked in, we didn't have any kind of big gyrations in any of the Asian markets at the start of the trading day. The SGX Nifty indicating that we'll have a start which is marginally in the green as well. Our markets, remember, it's an important day. It's an expiry during very volatile times, and therefore it makes this expiry very, very interesting. Rolls, I was just talking to Agam, the Nifty rolls and the Bank Nifty rolls are pretty much in line with what we usually see in or around this range. So no big changes. They were lower until Tuesday, but in yesterday's session, the rolls did pick up in a healthy fashion. So rolls are in line. The 11,000 put stays firmly as the top position to monitor, about 38.7 lakh shares. So no changes out there, and it seems like we'll defend that mark if the option traders are to be believed. The only disconcerting thing to my mind is really what's happening to flows the last few days because of all that's happening. Maybe due to ILFS, maybe due to the small crisis that is happening in India. I won't use the term crisis, to be honest. The small issues that we have on the liquidity front in India, I think that's spooking equity investors as well, not just debt investors. And FIs have been consistent sellers. Chats with almost all fund houses, etc., seem to believe that the reason why the foreigners are selling lock, stock, barrel over the last few days is because of all that's happening around ILFS and the liquidity in the credit system. So that number continues, 800 crores yesterday as well. Day before yesterday was about 1,200 crores. So the fund flow situation is a bit of an issue. However, having said all of that, and before we get to the big discussion, which is on the FOMC, the stocks that you should monitor today, 2 or 3 things to watch out for. First, the tire companies. The government has decided to increase the customs duty on radial tires. And Apollo and Seat, I've chosen these two because they have a larger proportion of domestic sales as well, 20% and 15% respectively. And those two could be in focus today from the tire space, though I believe all of the tire companies could react marginally on open. Voltas and Blue Star, two air conditioning manufacturing companies, customs duty on AC compressors have been increased, might impact prices. Now, it's a conundrum whether or not how much of a cost uptick would these companies be able to bear, and whether there is a net positive, net negative, or a zero impact. I would reckon that not too much of an impact, but expect these stocks to be volatile. NBCC, I thought, was interesting. It's a stock that's been bogged down because of various issues, but now they've received an approval from Air India to monetize or develop the land parcel in Delhi. That's about 33 odd acres. Let's see if there's a shot in the arm for a stock which has largely been flat for all of the current calendar with a bit of a negative bias. Maybe there's some positive news or positive movement today. However, what's lined up on first word today? The US Federal Reserve doesn't seem to be done yet with rate hikes. As I said, FOMC statement makes it quite evident that there will be a 4th hike in 2018. So Does it have a big impact on global market? We speak to Andrew Freris and Seth Freeman. Both of them join in to speak about this. Nikuj and Darshan then come in to talk about the impact of the customs duty hike announced by the Indian government. Sumit explains why rising crude oil prices need not be good news for the Indian oil explorers. And not all non-banking financial institutions which have to go to the market for refinancing their debt might have a tough time. Shraddha Babla Johnson to tell us what, to my mind, is the most important piece bogging the market. But start off with the biggest announcement that came in overnight. The FOMC raised interest rates for the third time this year on expected lines in response to the strong US economy. The quarter-point hike boosted the benchmark federal funds rate to a target range of 2% to 2.25%. First, listen into what Fed Chairman Jerome Powell had to say about the economy and the rates.
Each time my colleagues and I meet, we face the same question. How can we set policy to best support job growth and low, steady inflation? For many years, this question called for very low interest rates to help an economy that had been damaged by the deep financial crisis that gripped the world 10 years ago. As the economy has steadily gained strength, the Fed has been gradually returning interest rates closer to levels that are normal in a healthy economy. We took another step on that path today with a quarter-point increase in short-term interest rates. These rates remain low, and my colleagues and I believe that this gradual return to normal is helping to sustain this strong economy for the longer-run benefit of all Americans. As I mentioned, 10 years have now passed since the depths of the financial crisis, a painful part of our history that cost many Americans their jobs, their homes, and for some, their hopes and dreams. In addition to holding interest rates low to support the recovery, we have also taken many steps to make the financial system safer. In particular, we're holding the largest banks to much higher standards in the amount of capital and liquidity they hold and in the ways they assess and manage the risks they take. I'm confident that the system today is stronger and in a far better position to support the financial needs of households and businesses through good times and bad.
What's more, the Federal Reserve has cemented expectations of another rate hike before the year ends. Kathleen Hayes of Bloomberg News reports.
In justifying this, they said the economy is strong, the labor market is strong, and inflation is near target. Let's look at the dots, because that's the signal, not only that, okay, we've done the third rate hike with the September hike. Dots go on your Bloomberg shows you that now this dot plot, as we call it, this was 8, now it's up to 12 of 16 are looking for 4 rate hikes this year. They did drop the word accommodative from their policy statement as they were describing the stance of policy. Bonds did rally because they assume if the Fed dropped that stance, they might be more aggressive with rate hikes. But Jay Powell said, we just don't need it any longer. It doesn't make sense. The Fed can raise rates or lower them more quickly, more slowly. It's going to depend on the economy. Now, of course, he did say there's a rising chorus of complaints about trade and tariffs that could ultimately affect the economy. Stepping back from all this, people say the Fed has a tricky task now. They've got to engineer a soft landing, get to normal policy, and not cause a recession. That's the big challenge now.
Well, the US President Donald Trump is not very happy about the move, though, and he said as much in an address last evening, but that isn't surprising considering he hasn't been a fan of any of the previous rate hikes either. Here's what he had to say.
We are doing great as a country. Unfortunately, they just raised interest rates a little bit because we are doing so well. I'm not happy about that because I know it's going to be a question. I am not happy about that. I'd rather pay down debt or do other things, create more jobs. So I'm worried about the fact that they seem to like raising interest rates. We can do other things with the money. And but they raised them, and they're raising them because we're doing so well.
Well, that's typical Donald Trump, to be honest. But let's get an expert really on this to try and figure out what's the outlook looking like for FY19 or 2019, because somehow from the Fed side, 2018 seems to be a known devil, if you will. Andrew Freris, CEO at Econogsis Advisors, joins us right now from Hong Kong. Andrew, good morning. Thanks so much for taking the time out. Not surprising, really. I would reckon not even the dropping of the word accommodative was not surprising. And I think they have laid their hand bare when they've given out that there will be one more rate hike in 2018. What's your, anything that stood out for you from this policy statement? And what's your outlook for 2019? Does the Fed stay on course for the number of rate hikes that the market expects it to do?
they have been incredibly persistent and consistent. And don't forget, they started raising interest rates in the year 16. This is nothing, absolutely nothing new. There is no news here at all. And they say they're going to raise rates. They don't necessarily raise them exactly on the month we expect them, but they're doing so. And of course, don't forget, they started, if you think that the rates now are between 2 to 25, okay, which is unbelievably low given that the economy is growing at 3%, and they started nearly 2.5 years ago, it shows you still how low the rates are in relationship to everything else. Normally, the rates plus the real rate of growth should equal more or less. Sorry, the nominal rate of growth should equal roughly the interest rates. That's an incredibly crude way of looking at it, and we're not really there yet. In other words, if inflation is about 3%, then if nominal rates are 3%, then real rates are 0, and the economy is growing at 3%. So in other words, this is a very crude way of doing it, I emphasize. Okay, so yes, I think they will hike again before Christmas, and possibly they may consider at the very least 2 more hikes during year 19. No surprises here.
No surprises here. I think the market started reacting a bit when the word commodity was dropped, but I think Jerome Powell made it amply clear that it was not a policy signal.
You know, this is the usual thing, is right? It's like reading the Holy Bible, if you excuse my politically incorrect thing. You know, individual words have got huge significance. Did they say accommodative, or did they say easing, or did they say in the near or the long future? You know, they have said they're going to hike interest rates, and they will.
Well, Seth Freeman of Glassratner Advisory and Capital Group joins us as well. Seth, Andrew Freris was just saying that there were no surprises here. Somehow, of course, I think everybody agrees. No surprises. One more rate hike come December. The question mark only, therefore, is about 2019. Do you reckon that the Fed or any of the watchers are underestimating the power of the wage growth, underlying wage growth, and the impact that it has on inflation, and therefore the possibility of the Fed having to hike more aggressively than what the market or the Fed itself believes right now?
Well, there's a couple of things working at the same time. Don't confuse higher employment rates necessarily with higher wages. It's true, we're seeing significantly higher employment rates, but we have not seen in most of the country higher wages. So we're not really seeing inflation coming from there. Frankly, the tariffs, the trade war, and the price of oil will probably have more impact from an inflationary standpoint, both in the United States and globally. We also have a situation where mortgage rates are rising relatively quickly compared to the last 2 or 3 years. And the US economy is very dependent on real estate. Imagine somebody buying a home has an empty garage. They might buy a new car and furniture and so forth. And the housing market is flattening out quite a bit. And so on the other hand, the cost of home ownership is rising rapidly. Right. I think those are going to have much greater impacts.
So what's your assessment of what happens post-Christmas, Seth? On track for the stated objective or the believed stated objective of the rate hikes at the pace that everybody believes the Fed would do in 2019?
Well, you know, this goes back to this idea for many years that the Indian market is very sentiment driven. At the moment, consumer sentiment is very high. And so expectations for Christmas are very high. And that could carry forward through to 2019. From a more macro standpoint, we're seeing a flattening of the yield curves, and that usually bodes negatively for the future. So I think the Fed is just going to, like your other speaker mentioned, in many ways this isn't a surprise. I don't think dropping the word accommodative should be given a whole lot of interest. They're going to continue being data-driven. And on the same token, I believe the Fed's going to be very sensitive about avoiding raising interest rates too aggressively and forcing a recession. So probably 2019 we'll basically see more of the same.
Andrew, just one final word, and the impact that this hikes, as moderated they are and as on expected lines as they are, the impact that they have on EM flows. India has specific problems, but EMs at large or Asian markets by and large, any major impact on flows because of the Fed decisions?
Basically, no. Let's not forget the RBI started to hike interest rates back in April after it has lowered them for several quarters. So Indian interest rates are already on an uptick, and of course with the weakness of the rupee and the, let's say, if inflation, and that unbelievably, if I may say so, stupid policy decision to impose tariffs, for God's sakes, in order to repair the current account, it will only push inflation up. And therefore, it will make quite sure that the RBI will continue to hike interest rates irrespective of what the Fed did. Watch my lips.
Okay. Andrew Freris, thank you so much for taking the time out and being with us. And Seth Freeman, thanks for staying up all the way from San Francisco. Thank you so much for joining in today on Bloomberg Quint India. That's about the Fed. Now to the big policy decision is India. India has raised import curbs on non-essential items in an attempt to narrow the current account deficit and reduce pressure on the rupee. The government has increased customs duty on 19 items, including household appliances and jewelry, Nikunj Johri reports.
The government has increased import duty on 19 non-essential items, which range from air conditioners, washing machines to refrigerators. These import duty on these three items has been doubled from 10% currently to 20%. These rate increase, the import duty hike comes into effect from September 27, and this is one of the measures that the government had announced, that the government would increase import duty on non-essential imports to bridge the widening current account deficit. Now, other items on which import duty has been hiked is footwear, on which import duty has been increased to 25% from 20%, and radial car tires, on which import duty has been hiked to 15% from 10%. Another important item on which import duty has been imposed is aviation turbine fuel, on which import duty of 5% has been imposed from nil, and this is going to impact aviation companies which are already under duress.
Okay, how does this impact the domestic industry? A bunch of spaces. Darshan Mehta is here with an analysis. Darshan, good morning.
Yeah, so Neeraj, if you go through the 19 list, not all are in the listed space, but you know, here and there a lot of stocks will react. It's not a big development, but let's go sector by sector. Let's talk about aviation first. It's no doubt negative given the fact that ATF, the custom duty has been increased. Now, India does not import significantly of ATF. If you're looking at it in the fiscal, only close to 1100 crores was imported ATF. The fuel requirement was 30,000 crores. So you can see it's a negligible amount. But nevertheless, in a sector which is reeling under pressure, this comes as a negative because, cost will go up slightly for them when they are clearly not making money. So sentimentally negative, not positive at all. Tires as a space, yes, it benefits given the fact that there have been always pushes for putting import duty on imported tires. Radial tires here, Seat and Apollo have sizable chunk in it, and across the board, tire does benefit. So tires will see a positive impact. Now, I think the two important companies and which will react most will be Dixon and Amber. Amber basically deals only in ACs, so they are contract manufacturers. Amber for only AC, Dixon does a whole variety, including AC, refrigerators, everything they do. So what will happen is that a lot of these smaller players or even some of the larger companies may shift, if import gets expensive, they may shift the outsourcing to domestic players, which will benefit. And one of the Goldman Sachs report does indicate that Havells probably will shift. It has a good opportunity to shift to Amber. So these two companies will definitely react positively. Now Havells, it is negative, not because of what it does, because of the Lloyd's acquisition. Now 17% of Havells revenues comes in from Lloyd, and Lloyd basically is into washing machines, which is just 4% of it. The balance comes in from AC. Now they import most of it. So 70% of the ACs, compressor and all, is imported, while 30% is from Leel Infra. So that 70% is a big problem here. Havells no doubt is setting up their own facility, but that will come in FY19. So the option that Havells has is probably shift to an Amber or a Dixon, which will probably benefit. The other component for washing machines not that important, but nevertheless, for next one is again, you have Whirlpool. Whirlpool for refrigerators, yes, but only a very, very small. So it's basically neutral. Voltas is the other one. Why is it negative? They have a joint venture with a Turkish company. So the Voltas Bepco joint venture will import all these products that will be sold. But it's a very, very small component. So it doesn't matter, but they have their own plant that will come up, but that will also come up next year. So while whatever will be imported, yes, there will be problems. And the compressors are imported. For the room AC, not so much, because a lot of parts are made here. For the small window AC, for the room AC, yes, they are imported. So Voltas, the entire AC industry is affected because most of it comes from import. But Voltas will be slightly higher because their share is much higher there. The other are the footwear companies. Not much to speak about. They will benefit. Sentimental impact. Titan, it's positive because the negative news has not come in, and basically because of duties coming in, competition will become slightly expensive. So sentimentally, it's impacting Titan also. But 4 stocks I'll clearly watch out: Dixon, Amber, Havells and Voltas. These are the 4 stocks. Probably if the reaction will come in, will be more on these 4 stocks rather than the others.
So for Dixon and Amber, brokerages are saying that the impact would be positive. It
impact if the business shifts. So there's an opportunity here. So as of now, everything is on if it happens.
As it would be.
But nevertheless, yes, it's positive because some of the other people will, because if imports are getting cheaper, is getting expensive, they will shift to Amber and Dixon because they are the largest in India as far as contract manufacturing is concerned.
We'll watch out for these. Thanks a lot for that, Darshan. Remember, a conversation with the management of Amber Enterprises is coming up a bit later on at about 8:45 odd, so do stay tuned for that as well. And of course, the entire write-up around this is there on the website, bloombergquint.com, so do log in and read everything that you would want to know before the trade begins. Do log on to our website. The third piece on First Word, oil price boom is not just a hit for India's external balances. Corporate India has lots of worry about as well, with Brent touching the $81 per barrel mark. Companies that use oil in the form of fuel or raw material will see costs rise. What's worse, even explorers who stand to gain from higher realizations can't breathe easy if the rally continues. Somit Sarkar is standing by to tell us why. Somit, good morning.
Good morning, Neeraj. So if you see, generally oil producers tend to benefit with rising crude prices, but in India that's not the case. For ONGC and Oil India, which is the largest oil producers in India, now they tend to lose if crude surges beyond a certain limit. Now that is because they might have to share the subsidy with the government. Now for FY19, if you see, crude prices are expected to be around 30% higher, but the petroleum subsidy estimated by the government is hardly unchanged compared to last year. And because of this, ONGC in its annual report also mentioned that if the crude surges beyond a certain limit and if remains at an elevated level, they might have to share the subsidy burden with the government in financial year 2019. Now, this shortfall in subsidy burden increases the earnings risk for these upstream companies. Now for downstream companies, if you see with daily and free pricing, the impact of higher crude prices are generally passed on to consumers. At least that is what we have been seeing for the last few days. But during election season, this is not the case, because if you see in the past 2 election seasons that had happened right now, that was the Gujarat election and during the Karnataka elections, the marketing margins of these oil marketing companies had dipped severely, and that was because of no pass through of this higher crude prices, and that could impact the marketing business of the oil marketing companies. Now so far we haven't seen that impact in the second quarter, but if you see over the next 8 months, there are 9 state elections and 1 general election. Now this could keep the marketing segment of the oil marketing companies under pressure if crude remains at a high level or keeps surging beyond the $80 or $81 per barrel mark going forward.
Okay, but what about the sectors which are dependent on crude prices?
So I'll start off with the aviation sector. Now for them, it's about 1/3 of their total cost, that is the fuel cost. And given the current ticket pricing scenario in the aviation industry, their margins will be impacted because of higher crude prices. Now in Q1, the fuel cost per seat kilometer was on an average 30% higher and at its 3-year high. And this rise in fuel cost coupled with the ticket pricing environment had severely impacted the profitability of the airline companies. And this is expected to continue in the ongoing quarter because there has been no change in the ticket pricing environment. employment, and the fuel prices have also remained higher for the airline companies. Now, the second sector will be the lubricant manufacturer, that is Castrol India and Gulf Oil India. Now, crude is the main input material for them, and usually they pass on this by taking price hike, but it comes with a lag. Now, in the first quarter, we had seen the gross margins take a hit compared to last year because of higher crude prices. Post that, they did take a price hike, but given the recent surge in crude prices, the margins, that is the gross margins, could remain under pressure in the ongoing quarter also. Now comes the paint companies. Now, for them, it's 50% of the total cost is crude cost, and in the past we have seen that with rising crude, they have usually passed on this to the consumers, and there's no lag. So most of the impact they should pass on to the consumers, but we'll have to see how that pans out for them in the second quarter. Now, tire companies, now they use synthetic rubber and carbon black. Now, these are crude derivatives and not directly related to crude. So the price hike comes with a lag, and tire companies also pass on this hike similar to the paint companies to the consumers. So there won't be much impact, but we'll have to see whether they pass on this price to the consumers or not. Also, plastic manufacturers, now they use variety of plastic polymers. Now, they're also crude derivatives, but rise in crude prices will increase the prices of this polymer components and could impact the margins of the plastic manufacturers like Neel Kamal, we have Supreme Industries. So these companies will be in focus because of the rising crude prices. Now, one sector that tends to benefit because of this rising crude prices is the construction sector. Now, companies like L&T, KEC, and NCC, now they have a significant exposure to Middle East, and in past we have seen whenever crude is on an uptrend, construction activities in these countries pick up, and so they tend to benefit from that. Now, L&T is the biggest beneficiary here because 26% of their order book is from Middle East and 69% of their international business is from Middle East. So L&T will be one company that will be in focus because of this rising crude prices.
Okay, so if the orders come in, they could benefit, but from a pure sensitivity analysis, Sumit, just very quick 30 seconds, which is the space, which is the company that is likely to get impacted negatively the most if crude were to stay higher?
Most it will be the aviation companies.
The aviation companies. Yes. Okay, well, already under pressure.
Yeah.
Let's see how much more they can take.
In fact, HSBC came out with a note, and they are also deferring the Q2 preview because they cannot say what would be the numbers because of this current pricing scenario and the cost scenario that we have seen in the aviation industry.
Well, we like flying cheap, but it's having a toll on the aviation companies for sure. Sumit, thanks for putting that into perspective. Well, that's about crude. And then a lot's been said about the ILFS default and the rising liquidity concerns, but I think it's important to differentiate between the wheat and the chaff. There are NBFCs as a space has corrected. There are some which may not be impacted as badly, and I think therefore what Shraddha is talking to us about, it becomes very, very important. Shraddha, not everybody loses out. We are not out here to say that these stocks might be great buys, but just to dissect that some will be impacted more negatively than others, isn't it?
Yes, absolutely, Neeraj, that's true. And we will see which other NBFCs which seem to be better placed currently. But before that, why has this entire ILFS issue, the mutual fund risk aversion and liquidity tightness become so important for NBFCs? Two data points that I want to share. One is from a UBS report which says that mutual funds have deployed 17% of their debt AUM in NBFCs. And second thing is Credit Suisse report which says that over 40% of the NBFC debt papers are due for refinancing in the next 6 months, and that's a sizable number. And that is why this, this entire issue becomes important, because if mutual funds are not keen to rule over the commercial papers that mature in the near term, it could expose some of the NBFCs to refinancing and repricing risk. So let's see which are the NBFCs which actually have a huge dependence on market borrowing. So market borrowings could either be CPs or NCDs, so that's the short-term and long-term borrowing. It's LIC Housing Finance, India Bulls Housing Finance, Mahindra Finance, Bajaj Finance, PNB Housing, a lot of housing finance companies which have a market borrowing which is more than 50% of their total borrowings. Having said that, it is more important to focus on and understand what the ALM gap is, which means the asset liability mismatch, and we are looking at the less than 1 year bucket here right now. A positive gap is a good thing. So in case of Bajaj Finance, Shriram City Union, Mahindra Finance, Edelweiss, all of them have a positive gap, which is a good thing. It actually means that they have more assets which are maturing in in less than 1 year than liabilities, and hence the assets itself will be able to fund the liabilities and they won't be exposed to refinancing risk. On the other hand, if you look at Repco Home, Canfin Homes, they have a negative gap of 29-25%. Diwan Housing, LIC Housing, PNB Housing also have negative gaps. So a lot of housing finance companies are the ones which have a negative gap, which which means that they will have to replace their short-term maturing liabilities at a much higher cost, and that could possibly have an impact on the spreads, and not just spreads but also growth rates, because in the absence or in the difficulty of funding or a higher cost of funds, these guys might want to moderate their costs. Having said that, there's one more aspect that one should consider, and that is the pricing power. Obviously, the NBFCs which have a larger pricing power will be able to pass on the higher cost of funds. Which are the NBFCs which have a higher pricing power? It's the gold loan financiers, CV financiers, microfinance companies. On the other hand, it's the wholesale financing and housing finance companies which have a low pricing power, because especially these housing finance companies, because they already operate on very, very thin spreads as compared to the other NBFCs, and that has led to analysts preferring banks, because the primary source of liquidity for them is deposits, so it's easier liquidity. So Credit Suisse has said that they prefer banks in the current environment. Nomura has chosen to pick CASA heavy banks and rural financiers, whereas Edelweiss has turned cautious on NBFCs and they prefer HDFC and ICICI banks. So housing finance companies clearly seem at a larger disadvantage right now.
And a big no-no from almost everybody, though HDFC probably finds a mention here and there. But
because of the parentage, funding issues don't seem to be huge for them, so yes.
Yeah, it's interesting. But the whole idea of doing this piece is to tell you that there are some NBFCs which are better placed than the others, because the ALM is actually positive for them. Shraddha, thanks for putting this into perspective, really important. That's all that we have on First Word today. Lots more lined up on Indian Open. We discuss markets and macros with Mihir Vora of Max Life Insurance. Take a look at the new roadmap in the making at HDFC Life with the newly appointed Managing Director and CEO, Vibha Padalkar. After this break though, full tilt towards the day's trade.
Good news, got a promotion and a damn good raise.
Congrats बेटा.
वाह, raise? अब तो insurance policy ले ले.
कौन सी कंपनी से लूं?
Choose वही जिस पर हो पूरा भरोसा.
That's good. But आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC. Trending with times. 62 सालों से हर generation की पसंद.
When I started juicing to bounce back from a serious injury, I had no idea that it would turn into a passion, that would turn into a brand that provides healthy choices to millions of consumers. Today, my brand is a household name. I am Anuj Rakyan, and my story is a clean and a flavorful one. I'm the raw pressery guy, and I'm here to tell you my story only on Aegon's of Business.
Aegon's of Business never stop. Only on Bloomberg Quint.
Hi, this is Safir Anand. I'm an investor and I look forward to interacting and speaking at the Investor Carnival 2018 in Goa exclusively for Bloomberg Quint.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome back. You're watching Indian Open right here on Bloomberg Quint. Important to see what's been happening across Asia before we dive straight into our markets and see how we set up for trade this morning. So Asia is trading flat to slightly mixed bag, with Hang Seng trading higher by about 1/3%, the Nikkei, which is down about 1/10%, and absolutely catatonic for Shanghai. Nothing much happening on that front. For SGX Nifty, a slightly more positive start after yesterday's pullback that we saw in the markets. It'll be interesting to see how we open up on these cues. points. So about 1/3% higher for the SGX Nifty at 11,088. Remember, we've got expiry on our head, so it's going to be important to see how rollovers are shaping up, what's been happening in the futures and options space, and where that build-up is to give a support to the index in the case that we actually have to have another dive down. Agam is joining us with more details on all of that and more. Agam, good morning.
Good morning, Devina. Well, we're starting to see rollovers pick up. They're largely average in terms of what we see in the previous few months. Well, perhaps a tad below than the average at around 43% for the Nifty. And when it comes to the Nifty banking rollovers, that stands around 36%. And let's move in and talk about the other variables as well. So the India Volatility Index has risen by around 2.4% and still above the mark of 17. In terms of changes in open interest, what we're seeing is more writing around 11,100, 11,200 cohorts. And well, on the whole, considering the fact that your maximum open interest is around the 11,000 put, we're likely to see some amount of range-bound moves, considering the kind of cues that we're reading over the previous couple of sessions. Can we see the Nifty move on fall below the mark of 11,000 on the day of expiry? Well, we're going to have to wait and watch on that one. But the put-call ratio for now is at a fairly neutral level of around 1.09. Let's talk about stocks then. And Jet Airways and Punjab National Bank move out of the F&O ban. Diwan Housing Finance, on the other hand, is moving out, and Jet Airways and Punjab National Bank move in. And in terms of stocks, we're looking at Tata Motors, where it has seen fresh shorts come through. And speaking of fresh shorts, we're also seeing a lot of shorts building in ITC as well. Titan, on the other hand, which did move up on the back of a brokerage note, that's starting to see some short covering, and across series we're starting to see a little bit of a decline. That said, we're going to have to wait and watch whether or not we do see the same reaction. But once again, all eyes will remain on the indices and whether or not the Nifty can hold on and defend 11,000.
All right, Agam. Thanks very much for that. So 11,000 nonetheless being a very crucial marker for the indices on the downside, at least, and the kind of option support that we're getting there from the put side. But let's bring in Parthiv Shah. He's the director of TRACOM Stockbrokers. He's here with us to discuss the markets and more. Parthiv, what are you going to be doing now? I mean, with expiry around the corner, what's the sense, and what kind of trades would you like to initiate during expiry, or probably even for the next few months to come?
Good morning. Unfortunately for India, I think the headwinds in terms of the macros are deteriorating day by day. Very sad to see that crude is inching up and going up to levels of $82. And I think that certainly does not bode well for a lot of our macros. And I think we know for the fact that it has a domino impact in terms of a lot of industries, a lot of sectors, at a point in time when we are trying to recover and trying to target that 15 to 18% sort of an earnings growth. But nonetheless, I think these are, things which happen around the year. And I think we know for the fact that whenever in the Indian markets, the valuations tend to come down, and luckily, I think this time what we have seen is a massive correction where not only I think the usual suspects, the tainted balance sheets, the tainted managements, but I think luckily the good quality companies have also cooled off. And I think if I were to see in terms of the quantum of the correction, it's been to the tune of 15 to 20%. So I think my sense is this is a great time for one to realign the portfolio. One will have to really, I think, retrospect the portfolio and check out for all sorts of names which could, I think, potentially have lots of headwinds going ahead in the form of either weak rupee or in the form of higher rising rates and all those sorts of things. So I think it's a good time to realign portfolios into companies, into sectors where the growth is there, irrespective of this macro headwinds, irrespective of higher inflationary pressures. And I think those are the type of stocks where a lot of money will flow in. As such, the liquidity is going to remain tight. So I think it's a good time to rely to such sectors. If I were to name some sectors, I think life insurance, I think these companies have been battered down. I don't see that the business model is going to change. It's going to be a growth story going ahead. Some of the private sector banks, I think whatever woes that NBFCs are facing, they might have a slowdown in terms of the lending. And again, I think the private sector banks are going to steal the market share, not only from the PSU banks, but also from these NBFCs. So I think these are the type of sectors where I think the growth trajectory could be good going ahead.
I just want to quickly, Parthiv, highlight the most important piece of news that we'll see stock reactions as we open up for trade this morning. Firstly, on the kind of duty hikes we've seen across the board. For some of the tire companies, what will happen? What's your take on what happens to stocks like Voltas, Havells, Whirlpool? And the other bit is for the aviation turbine fuel. So the aviation names, the Jet, Indigo, which have any which ways been reeling with pressures of the higher crude oil prices. What's going to happen to these stocks?
See, firstly on the aviation stocks, I think it's going to be extremely painful for them, because even a 5% hike that they have proposed for the aviation turbine fuel is not at all going to help their cause. And especially at a point in time when these guys are struggling with yields, forget about the passenger growth, everything is fine, but the growth is not happening with incremental cash flows. And even if I were to forget a name like Jet Airways, which is purely tainted, and since a very long time on your show I've been suggesting an avoid even when oil was at lower levels. And I think Interglobe Aviation, SpiceJet, which relatively are better placed, but still I think these two players are struggling. One had always thought that in the aviation sector with very few players, I think having a dominating market share, names like Interglobe, SpiceJet, Go Airlines, which is though not listed, I think they will always get that pricing power. But unfortunately, we have seen that pricing power has not come back. In fact, they are not even willing to raise their prices to an extent to recoup the losses that they're facing with a higher crude and depreciated currency. So goes to show a lot of pain is there for these guys, and unless and until they were to correct by another 10 to 15% from here, which I see definitely a possibility, I think I would not touch this sector. Talking about the other white goods stocks, names like Voltas, Whirlpool, my sense is many of the MNC plays, names like Whirlpool, which have been massively re-rated, something like a Hitachi Life, I think, which is now a Johnson Control company, they are the ones which might get derated, because I think a lot of their components they were importing, and now they'll have to try and change the business model to have local sourcing. But I think one beneficiary that I see of this is going to be a company like Ember Enterprises, or for that matter Dixon Technologies. I think these are the Make in India themes, and I think all the custom duty, import duty that has been put, I think should benefit such players, and they are continuously working on backward and forward integration, providing the right solutions, localized solutions rather, I would say, to their customers. So these are the two companies where investors could, I think, bet on a longer horizon.
All right. We'll come to the tire companies in just moments from now, but we got a lot of stocks to talk about and what's been happening and the kind of reactions that we might see to some specific news that we are here to cover for you. So our entire research team is here with us. We've got Shraddha, Nikki, as well as Somin joining in with more details. Shraddha, I believe some stocks and news today from you?
Yeah, so HCL Tech is one of them. They've signed a fire infrastructure deal with Anglo-American. SBI might remain in focus. They have divested 4% of their stake in SBI General Insurance for 482 crores, which values SBI General Insurance at about 12,000 crores, but some fund inflows for SBI. Hero MotoCorp will hike prices from 3rd of October, and that is mainly on account of the higher commodity prices and rupee depreciation. Torrent Power has won an order for 115 megawatt wind power project. You have ITNL, which will be in focus, that is ILNFS Transportation Networks, and this is on the back of a ET report which says that Italy's Atlantia is in talks to buy ILNFS road assets for $1.2 billion, and the report also says that this deal will remove 25,000 crores of debt from ITNL, so clearly one stock to watch. Also two interesting bulk deals. One was in Diwan Housing Finance, where BNP Paribas picked up 1.64% stake, and the second one is Astra Microwave Products, where HDFC Mutual Fund has sold 4%. That's sizable, so lots of smaller stocks to name.
All right. And one interesting stock, TD Power, I mean, the buyback there, but more interestingly, the pricing at which they want to do the buyback.
Yeah, so they've come up with a buyback offer of around 30-odd crore, and this the company intends to buy around 11.7 lakh shares from open market, which represents around 3.53% of equity capital. The price of the buyback is at a maximum of 256 per share, which indicates a premium of 81% from the current market price. However, if the company decides to buy back less than that, in that case the equity capital will increase. After the shareholding pattern, pre and post, promoter holding will increase from 54 to 57, and public shareholding will be around 45. It will decrease to 44% in that case. Now the company is it does have a debt on books. Cash position is around 52 crore as compared to 45 crore that we saw in 2017, and in terms of debt, the company is right now sitting with a short-term debt of around 69 odd crore.
All right, Nikki, thanks a lot for that. And Samit, I believe you've got Garden Reach IPO on your list?
Well, the IPO is not like failed, but it has been extended because of poor subscription numbers. Now, yesterday was the last date and the total subscription number yesterday was only 0.67 times. Now, this has urged the bankers to extend the IPO date for 3 more working days till October 1st. And they have also revised the price band downwards to around 114 to 118 from earlier price band of 115 to 118. Now, this is the first government IPO, at least in the last 3 years, which had to be extended due to poor response from investors. Now, in the last 3 years, 10 government companies have come out with their IPOs, and out of this, 6 of them have seen subdued demand from investors. In fact, LIC has been putting in money in most of the money in these IPOs. Now, this sluggish demand from the investors has also impacted Awas Financial's subscription numbers. Now, at the end of D2, the IPO was subscribed only 0.29 times. So now let's see how the subscription pans out for Garden Reach over the next 3 days and for Awas Financials, as the last date is today.
All right, guys, thanks very much for that. So, a lot many stocks that you need to keep an eye out for as we open up for trade this morning. Parthiv, we were talking earlier about the duty hikes and how they impact each sector. I think we were missed out on the tire companies. What's your view there?
Yes, an additional 5% duty hike on the steel radial tire imports, I think, is certainly good news for the industry. Domestic industry will be, I think, encouraged in terms of all the investments that they have been making. And I think there was always a fear that a lot of dumping was taking place, which will certainly, I think, alleviate the fears. And I think as such, the domestic tire industry is doing well, earning very decent margins, which is helping them in their capex cycle. And the demand for tires going ahead, I think, should be very stable. With the rubber prices also, I think, not really being a big worry. I think all of that should bode well. And along with this import duty, I think some stocks, especially stocks which have a decent share in terms of the replacement market, a name like MRF, I think MRF has almost a 40% market share in the replacement tire market, I think should do extremely well. So I think MRF is a stock in the tire segment which we are looking forward to, and a stock like Balkrishna Industries.
Okay, we'll watch out for all of those names as well. So keep in mind, a lot of stocks that will react today, and we'll talk about all of those. We've spoken about some of those already. Talk about some of those during the course of the day as well. The SGX Nifty pointing towards a third of a percent in the green, so likely to have a positive start as well. Let's get in our technical experts on board. Meanwhile, some RBI flashes as well. I think just to dwell on that for a minute, we'll also try and get in Ira to just speak about this, but just to dwell on this for a minute, I think for some time now, we've been wanting regulators to come in and talk about and give assuages to the market, much needed ones. A couple of flashes that I have: the system liquidity, RBI says, is an ample surplus and they stand ready to step in when required. Ira Duggal now joins us on the phone line for the latest move taken by the RBI to address these concerns. Ira, what do you think?
Neeraj, I think they've done 2 or 3 things. Well, they've actually only taken one new measure, but they've given you numbers to say what all they have done so far and assured that the liquidity situation is not as bad as people make it out to be. So I'll tell you what they've done. They have allowed a greater carve-out, as it's called, from the statutory liquidity requirement, which is bond holdings of banks. You can take more out of that bucket to meet your needs of LCR, which is a requirement under Basel III. Those 2 things, I won't get into technicalities, tend to overlap a little bit. So the RBI has been allowing a carve-out from SLR for use of LCR. Earlier it was 13%. Now they've allowed a 15% carve-out from SLR for the use of LCR. That does ease up the requirement for banks, particularly at the short end. It should be helpful. It will, in particular, help banks which are, private banks which are running high credit deposit ratios and hence need additional money liquidity. So they will be able to use that. That's the only new thing that they've announced. It's not insignificant, but it's not a huge deal. The other thing that they have done is tell you that, look, we've been doing things on the liquidity front, even if they're not big bank. We have done 2 consecutive open market operations this month. They've been typically averaging 1 a month. They've done 2 this month. So that's 20,000 crore added. They have also done yesterday a fair amount of term repos. They had announced the second window for term repo as well day before yesterday. So they have said that they put in more than 1 trillion in terms of term repos as well, apart from what banks can borrow from the RBI's last window. So they are essentially saying that as things stand right now, they think that the liquidity situation is actually comfortable. And from here on, they will continue to monitor and do whatever is requirement. Of course, all of the RBI's comments and measures are directed at systemic liquidity, Neeraj. So, if the problem is more about liquidity with NBFCs or with mutual funds facing individual redemption, that's a separate issue. But at a system level, they're telling you that, this has been done and this is the more, the one SLR to LCR requirement is the additional step that they've taken.
Yeah, just one follow-up. You would have spoken to a lot of market participants as well. Is this the extent of measures that they want, or would they have hoped for something that the RBI has not done till now and can do as well?
So I think, the extreme measure that everyone was talking about was, something like a liquidity window, a line of credit kind of window for mutual funds if redemption pressures become very extreme. But you would know better if we've reached that situation or not. They used that last in 2013 when there were significant redemption pressures on mutual funds. We don't, going by the fact that the RBI has not announced that, they probably do not see the situation to be that extreme, or they feel that those kind of windows don't help, because even when those windows are open, they don't really get used. They act more as a sentiment, stabilizer more than anything else. But I think from a money market perspective, from say bond deals, short-term rates, etc., this is okay. And they're right that in the last 2 days things have eased. So if you get, our producers to pull up the BI banking liquidity indicator, I was watching it yesterday while everybody was focused on Aadhaar. Day before yesterday it had peaked. But yesterday liquidity conditions actually did improve. So you'll see a nice fall in the deficit number on the banking liquidity indicators. So I think from a system level, they're doing what is required. Now, whether the banks on-lend to NBFCs because of these trust concerns or not, that's a slightly separate issue.
All right, Ira, thanks a lot for putting that into perspective for us. That's Ira talking about the measures that the RBI is taking to probably put a stem the systemic liquidity issues that we could be facing. But let's get straight to our market guest then. Shrikant Chouhan, Senior Vice President of Technical Research at Kotak Securities, is joining in right now. And to take us through his views, Shrikant, what's the sense in terms of stock positioning that you stand at right now? And on the index trade, is there a possibility that we stick on to 11,000 and probably see a short-term bounce from here?
Good morning. I think, the way yesterday there was a huge amount of put writing at 11,000, and even if we go through with the overall series, then there was huge amount of writing around 11,000 strike price. So it clearly shows that markets are going to hold somewhere around 11,000 levels, and on the higher side 11,150, 140 is the area of resistance. Basically, since this Friday's fall, markets are trying to stabilize, and that is why we are going to see some range-bound activity for next few more days. We are of the view that 11,200 is going to act as a strong barrier for the market, and on the downside 11,000, and below that 10,900. So in case, because of any reason, if we see the market is breaking 10,980, then we can expect steep sell-off in the market. That may take the market to the levels of again 10,850. But on the day of expiry, we are of the view that 11,000 is going to act as a very good support. As we are opening higher, my strategy is to go short again, because markets are going to remain in a range. So ideal strategy should be to look for taking short positions at 11,110, 120 with a final stop loss at 11,150 on the higher side as per spot levels.
Interesting. Nooresh, good morning to you. How are you approaching trade today, either for the expiry or for the near term?
So if we look at Bank Nifty and Nifty, what we are seeing is we've seen a bit of recovery over the last couple of days. So what we see is Nifty, if it continues to hold on to 11,000, we can see a move towards 11,150, 200. So similarly, Bank Nifty, if it continues to hold about 25,220, we can see a move towards 25,800. So that could be the short covering trade. And only when we start crossing 11,200 is where we see a reversal on the Nifty in a big way. So this could be the trade for now, wherein we buy closer to 11,000 with a stop loss, very small stop loss, and a target of 11,150.
Okay. Specific stocks very quickly. Nooresh, what are your stock recommendations for the morning?
So we continue to like metals as a space, and in that the top two ideas would be Vedanta and Hindalco. Vedanta has given a breakout yesterday, so looking at a target price of 260 and a stop loss at 236, and Hindalco looking at 260.65 and a stop loss of 240.
We'll come back In fact, Shrikant, quickly run through your ideas as well.
See, like along with metals, we like cement companies, and there we feel that Ultratech is showing a lot of strain. That is very close to its important support area with a stop loss at 4020. We should look for initiating long positions on Ultratech, and we can expect targets of close to 4120, 4150. The other one which we like is from the pharma space, that is Cipla. With the stop loss at 665, we should look for adding the stock with a target of close to 690.95.
Okay, Ajay Sahai, Director General and CEO of FIO, joins us right now on the phone line from New Delhi. Mr. Sahai, good having you. Thanks so much for joining in. How do the latest moves impact the space at large, or the buckets that will get impacted? Because the belief generally is that while air conditioning companies will benefit, compressors are getting imported, and that will have a problem if what happens to the radial tires because of the less penetration of the Indian companies vis-a-vis the imports, and that might have an impact. What's your general sense?
In fact, most of the products which are covered are in the nature of the consumer goods. So I don't think that by and large it will impact the common person, though of course I do agree there are certain products whose costs will go up, and the whole idea is that this may provide some fillip to the manufacturing, and it will be a kind of double protection. The rupee depreciation is already providing enough protection to the domestic market, the domestic manufacturing, and this will be over and above that. I personally feel that these kinds of tariff increase are temporary in nature. They will provide the domestic manufacturing to get a base, and thereafter they can definitely look into the import substitution of many of these products. So in a way, this is an attempt to reduce the trade deficit and therefore manage the current account deficit also.
Right. So, but for some of them, import substitution doesn't come in up until next year when they have, domestic manufacturing that kicks in. So, in that light, then does that negatively affect them?
I do agree that there are few products where the consumer may be impacted, but that always happens when you increase the tariff on the finished products. I think the whole idea is that if we can build domestic manufacturing, I do agree with you that it takes time. But if you look into the many countries, wherever they have looked into developing the domestic market or attracting the FDI, they always raises the tariff. So in a way, it may help India also to attract FDI in some of these manufacturing sectors also, provided these tariffs stay for a little longer time.
Just on a, not on a big scale, but on a smaller scale, do you think that this is counterproductive to growth for some of these companies? Because while you're targeting CAD on one side, there could be pressures building up for these companies, which could be counterproductive for growth.
Only in cases where we have touched some of the parts or components, if the parts and components are not domestically available, then the production costs may go up. But still, since on the end product also the duties are being increased, it's not an issue of inverted duty structure. And domestic industry will definitely enjoy the benefit. That's, of course, I agree with you that if the part prices go up, the consumer may be impacted because of that.
Okay. Mr. Sai, we'll leave it at that. Thanks so much for taking the time out and joining us and giving us that perspective. Well, let's see. Amber Enterprises and Dixon are two names that almost everybody believes will benefit out of this. Let's wait and watch what happens to those stocks. Let's also talk about counters which have been reacting the last couple of sessions. Yesterday's trade, BEL, Exide and Deepak Nitrite were amongst companies that really shot up in trade. Parthiv, I know you tracked two out of these three at least. Quick thoughts here, either a BEL or a Deepak Nitrite. Fundamentally, both of those have some triggers.
Absolutely, Neeraj. Great growing for Deepak Nitrite. I think the acetone, the project that they put up, which is of 1,600 crores, phenol and acetone, I think that should do phenomenally well. And I think the spreads that they're earning are at historical high. And I think some ballpark calculation that when they had put up this project we were doing is at $600 spread. I think they would be kind of recouping their investments over the next 4 years. And now with the current spreads and especially the way currency has behaved, I think they should be in a position to do the same in next 3 years. And I think that is very important because I think after this capex, the management is going to target more downstream assets capex, which is going to be more value added. So I think it's great going, and probably that's been the reason in the mid-cap carnage, Deepak Nitrite has done so well, and still we are extremely bullish on this counter. It's a massive capex, and we are expecting over the next 2 years, at least I think they should report double the PAT, double the EBITDA, and I think even repay a lot of their debt that they've taken for Deepak Phenolics, which is the subsidiary company. Talking about BL, I think we know for the fact that at one point in time we had a discussion to avoid this counter just because of the government intervention, and I think all the capping up of their margins that they can earn, and the stock had really gone down a lot, 30-40% from its peak, and now probably we're seeing some recovery. They still have this 50,000 crore worth of an order book, plus I think they're talking about this impacting after 3 years, because there's a lot of executable order which will not be impacted. So probably the market is taking some respect, but still I think I would avoid this counter. The only reason being the spend in defense going into elections could be a little tepid, which could, I think, not put this stock in the limelight again. So I would avoid this counter right now.
All right, gentlemen, just stay on with us. We've got about 20 seconds left to go for market pre-open. Let's quickly, take a look at what's happening across Asia. So the last time I took a check, it was, fairly flat, and it's not changed much. Just the fact that Hang Seng has now moved into the red. For the SGX Nifty, still perched with gains of about 0.25%. 11,080 is where we are currently trading at. For our markets, that's the pre-open initial ticks for you. The Nifty flat, Sensex up about 0.75%, 273 odd points higher, but that will change shortly. In terms of stock-specific moves, just quickly pulling up what's happening on the indices. So an HPCL stacks up at the top with 10% gains, but that's just the preliminary froth that you're seeing on the pre-open prices. Infosys, that's also showing a 10% tick on the upside. Yes Bank, 2% higher, and Ultratech Cement is up about 1.2%. Titan is up 1.3%. GAIL has moved up 1.2%. IndusInd Bank, Bharti Infra are some of the other gainers. Vedanta is up with gains of about 0.5%. Sun Pharma is up 0.5%. And from the IT backer, Wipro also does okay for itself. That's up. TCS is up 0.5% too. So most stocks in the green this morning, not bad going. Z, however, stacks up at the bottom, closer to 2% given up. UPL is down in trade today. We've got HDFC Bank losing about 0.5%. Reliance Industries down 0.25%, but nonetheless, if you count on your fingers, a handful of 6 or 7 stocks in the red this morning.
Yeah, the currency, Devina, was showing a bit of an uptick too. So yesterday it closed about 7 paise stronger. Today about 72.41, so another 20 paise stronger right now for the rupee. The bond yields were hovering around the 8.07 mark at close, currently about 8.407 as well. So no big changes thereof. There was a free trade in Vardhaman Textiles. I think that's changed. But let me just try and tell you what's moved around. The tire companies, Apollo Tyres is showing this big, strong reaction of 8.5%. I don't know if it will last or no, but it is for now looking good. CEAT, MRF, etc. should come up. I think CEAT and Apollo have a high proportion of exposure to domestic radial market, and maybe that's why the market might believe that those companies would benefit. Amber Enterprises as well as Dixon should come up on your screen next. The general consensus seems to be that these two companies might benefit. Let's wait and watch if that happens or not, whether the market believes that will happen or no. Dixon starting off about a couple of percentage points higher. Whirlpool has this big up move as well. Again, too early to call this a trend, but for now, in the first 2 minutes of the pre-open session, all over the place actually. Let's not dwell too much on this. What else? A couple of gainers from yesterday's session, now Carcorp, etc. And Deepak Nitrite. Let's see what both of them are doing today. Last but not the least, the aviation counters should come up on your screen. Deepak Nitrite 306, and then aviation, Jet Airways, my goodness, down 10%. Interglobe 3.5, SpiceJet, and let's see what that one is doing. For a space that was being touted as extremely secular growth, showing somehow the stocks have been taken to the cleaners. Down and out really for these names. Well, we've taken a fundamental view on aviation already. Devina asked Parthiv about Jet. Nooresh, let me ask you about whether the charts indicate any kind of possible trades on the aviation counters, any of the 3 names.
Like say, they're all in downtrend, so it continues to be a short trade. But the problem is with the current correction over the last few days, the risk reward is not favorable, so it would be an avoid specific.
All right. Just want to take in a few viewer queries which are coming in on a few stocks, and one particular stock being Tata Motors. I mean, that stock too seems to be down and out. You saw pressures building up around Tata Motors, DVR as well. At around 235 right now. Shrikant, what would you do with the Tata Motors?
See, currently the stock is like trading below its important support area of 255, 260 because there the stock has spent a lot of time. But in this particular fall, we are seeing that the stock is comfortably trading below this mark. So the next level to watch out for is between 225, 230, where the stock is having next important support area. And currently it is just like falling after like hitting the levels of 280. So at this point of time, it is better to stay away for the time being. But in case if there is any fall because of any reason, I think we should look for adding the stock close to 225 because the stock is turning over and above oversold on long-term charts.
Okay. Two other stocks from the NBFC space, most active, Diwan Housing Finance and L&T Finance.
See, for Diwan Housing Finance, our view is that it is better to stay away for the time being because there is like high amount of news flow which is going to keep the stock highly uncertain. So it is better to stay away from Indiabull Housing Finance as well as DHFL for the time being because they are not going to give you specific trading kind of activity for next few days. But yes, we like L&T Finance, which is like fallen badly, and always like we have seen that whenever there is a specific fall in any specific sector, we should look for adding few good companies from that particular space because whenever like that sector starts stabilizing, good companies rebounds sharply. So we like Bajaj Finance, we like L&T Finance, and while looking at yesterday's closing, which is around 132, 133, we are of the view that around these levels we should look for adding this stock to our positional portfolio instead of taking any short-term call.
By the way, the stock that is showing a definite downtrend or downtick at the start of the trading day today seems to be Voltas. Jet Airways, yes, but Voltas in particular on news down about 5.5%. Now, Parthiv, I know we spoke about some of these counters earlier, but a lot of viewers who tuned in right now would want to know that with the fact that compressors will now cost more because large portion of compressors are imported, is this a really big negative for Voltas or not quite, and you would be happy contemplating an investment in Voltas if you were earlier because of a possible price cut that is looking like coming in right now?
See, Neeraj, my sense is could be an overreaction. Frankly speaking, I think these are the quality companies having pricing power. And I think, again, AC demand in a country like India has become more seasonal in nature. Of late, we had seen that the summer was not very intense and we had seen degrowth in terms of the volume that they were enjoying. But again, I think in our country, still the penetration in terms of the AC is quite low. And Voltas certainly has a very respectable position and the distribution network that they have. I won't be surprised whatever hike they will have, a bulk of it, they'll pass it on to the consumers and save and protect their margins. They might cut a little bit here and there on the advertisement spend, but certainly I think I'm very confident that the competent management that they'll work on to mitigate these cost structures to try and save their margins. And I think the demand going ahead over the next 2-3 years is going to be good. Luckily, I think the valuations have derated thanks to such news, which is always a good thing for a new entry point for a new investor. It's a quality franchisee. I think the balance sheet is rock solid, and these are the times when I think one were to invest in a stock like Voltas, for the next 2 to 3 years, the return should be incredibly good.
All right. Voltas there, the stock's done about 3.5%. Quickly taking a look at what's been happening in the tire space as well because of the duty hikes. We've got the management of JK Tyres joining in right now. Mr. Ashok Kumar Kinra, he's here with us on the show. So thanks very much for taking out the time and speaking with us. What is the impact for you with regards to this increase in the duty, sir?
What is the impact on you? Duty.
Mr. Kinra, can you hear us? No, I think we've got him on a bad line. Mr. Kinra, can you hear us?
You see, the duty of the car vehicles have been increased by the notification yesterday. I think there is already enough production in the country, and that was the right thing to do. So I don't think it will have any major impact on the prices. Already the demand is good, and the entire demand is being met by the local supplies. So I don't think it will have any much impact.
So how much? What?
And in any case, all the kinds of car tires, right from the smaller size to the biggest size, these are being produced within the country. So my personal take is that it will not have much impact on the prices or on the availability, because already everything is being produced in the country and everything is available here. Yeah.
I'm sure it is, Mr. Kindra, but the question is, the belief in the market is that because there was some quantity of radial tires being imported, now that will be substituted by Indian manufacturers. You don't think so? Mr. Kindra? I think
suddenly the tires which were being imported, the measure that duty goes up, that helps the Indian industry. But again, I still maintain that there was enough supply already available in the country. Every demand was being met within the country. So the import was still of the car radials was a smaller proportion. So I personally feel it will not have much impact on the Indian tire industry.
All right, Mr. Kindra, thanks for clarifying that for us. So not any meaningful impact on prices, as he highlighted.
Or substitution for that matter.
Yeah, because he said most of them, any which ways, are within India and they supply within India. So
yeah, so this kind of pours a bit of cold water, because I think the market is excited with this piece of announcement, but JK Tyre saying that all of it was supplied by Indian companies any which way, so no big impact on prices, no big impact on substitution either. Well, the tire companies at the end of the pre-open session, though, seem to be doing okay. By the way, just pull up the tire companies, all of them. Yeah, marginally higher. So maybe the market is listening in to comments coming in from the tire companies, including JK Tyre. I must say, just before we head to all you need to know, something's happened in Igarshi Motors, 689. Just pull up that stock. It is showing an uptick of 20. Volumes are thin. It's showing some big uptick. Let's give it some chance to stabilize, maybe on volumes or otherwise, before we talk more about it. Let's tell you all that you need to know to stay ahead in trade. Today, a bunch of names which will be reacting. First up, companies like Havells, Voltas, Dixon and Amber will be in focus as the government hikes custom duty on 19 items as AC compressors to aviation turbine fuel.
SBI's board has approved divesting 4% stake in its general insurance arm, SBI General Insurance. The stake sale to Axis AMC and Premji Invest will fetch India's largest lender 482 crore rupees.
If you're a shareholder of TD Power Systems, here's some good news for you. The company has approved a buyback of 11.7 lakh shares at a price of 256 rupees a share. The price is an 80% premium to the current market price.
Reliance Capital will be in focus as Devang Modi, Executive Director and CFO of Reliance Commercial Finance, is set to exit the company by December 31st.
In bulk deals, BNP Paribas bought 1.64% stake in Dewan Housing, while Wellington purchased 0.68% stake in Apollo Hospitals.
And among key brokerage calls, Goldman Sachs upgrades Asian Paints to a buy and hikes the price to about 1550 rupees.
Okay, Parthiv, before we thank you, if you had to bet on one stock as an investment candidate right now, what would that be? Would it be a life insurance company?
Yes, I think, Neeraj, I think you know me very well. It's going to be HDFC Life. This stock has corrected from levels of 560. It has come down, massively battered down. And probably the only fears that the market has is the management transition. But I'm extremely confident on such a franchisee where they know how to transition the management. And I think their strategy is bang on. They are the first movers in the protection business where they're earning fantastic margins. And I think this growth story, and one had fears that, especially with HDFC Bank empanelling players like Birla, Tata AIG, I think that share will come down. But certainly, I think this is such a strong brand. And I think LIC having 28 lakh crore AUM, certainly either is going to stay there or might get reduced going ahead. So these private guys are going to enjoy. So HDFC Life after this correction looks extremely good, and this is a stock that one should hold over the next at least 5 years.
All right, Parthiv, thanks very much for joining in. HDFC Life is a stock that he's putting his money on. Let's quickly tell you what kind of trades you can take as we enter trade this morning. Top calls from our technical analysts. So we'll start off with you, Nooresh. What's your top call for the day?
That would be Vedanta with a target price of 260 and a stop loss at 234.
All right, stop loss at 234. Vedanta would be a top call there. Shrikant, what would you be doing?
I think, see, Cipla is like more convincing as compared to Ultratech because Cipla is very close to its upward breakout and overall pharma is doing really well. It is into continuation formation, so we can expect 690, 695 kind of levels, and markets are like completely following to defensive stocks. So it's a buy at this price, Cipla, with a stop loss at 665, and we can expect 690.95 on the high side.
Okay. Nooresh, you mentioned Vedanta. Anything else in the metals pack that seems remotely attractive to you? Not just steel, but you know, like the likes of a Hindalco, a Nalco, a Hindustan Zinc.
So Hindalco and Hindustan Zinc are both close to breakout. So Hindalco looks more interesting at current levels, wherein we see a breakout about 250 and a target price of 265 in the short term.
Well, interesting. So do watch out for those companies as well. And remember, both our experts have mentioned that stay away from aviation. They are in a downtrend, but may not be worth a short call right now. About 25 seconds left. The Asian screen, remember, looks reasonably green. So mixed bag, yes, but a fair bit of green on the Asian screen as well. Our markets, the pre-open session has already indicated they will start off about 0.25% higher. Question mark only is whether it stays there or does it go down. But 11,000 seemingly a strong support. But here's how the equity markets, Indian equity markets, are starting off this Thursday morning. About 0.25% higher than Sensex, actually more so. But let's wait and watch what happens here. The Nifty Bank about 0.25% too. Yeah, so just in and around those ranges. The mid cap and the small cap indices should come up on your screen as well. Mid caps flat in trade, small caps too flat in trade. So no big changes really at the broader end of the spectrum. In fact, the key benchmark indices, the Nifty Sensex and the Nifty Bank too, have cooled off and now lying absolutely flat. Look at this. Very, very flat for the markets currently. What's not doing well? HDFC about 1% lower. Indiabulls Housing about 1% lower. So after a bit of a relief rally yesterday, some pressure on Indiabulls Housing yet again, the top loser currently. Bharti Airtel has some losses to it. What about the gainers though? Titan, no surprise, yesterday about a couple of percentage points. The overhang of duties, etc. goes away. That's what one of the brokerage notes stated. So Titan continues on its merry ways. 2 days now has had some gains. GAIL about 1.5% higher. Asian Paints marginally higher. But no big changes really on the index stocks at all. The expiry day is starting off relatively muted for the indices and for specific stocks on the index, save for Titan. No big movers. Even that one is now eclipsed by GAIL. Maybe the broader market has some moves. Before I hand it over to Devina, just 2 or 3 pockets that I do want to highlight. Some stocks from yesterday's session, some stocks trading lows, and some stocks in news. Firstly, top movers from yesterday's session, BEL marginally higher in trade. Exide, well, starts off rather flat, but Deepak Nitrite at 299 starts off about a couple of percentage points higher. A couple of others, the import duty hike impact, if at all. Not much on CEAT, and the management of JK Tyre quite practically told us as well what would happen there. Amber though starts off 5% higher. Voltas, unfortunately for itself, 4% lower, amongst the top losers. Last but not the least, stocks which are trading at 52-week lows yesterday had deep gashes, and well, all of them continue to grind lower. Dhanuka Agritech about 1.5%. New India Assurance and PNB Housing, which had a slam dunk yesterday, continues to grind lower. Devina, what are you spotting?
From yesterday's session, actually, we are seeing a continuation of the uptrend on our Hathway cables. Stocks up about 5% though the mid-cap index itself is down closer to a quarter. There are stocks which are moving. You've got the likes of JK Tyre. You just heard the management on the show. The stock's up about 4.5%, though he did, like Neeraj highlighted, mentioned it's not a very big upside for them, but the stock's nonetheless active. Gujarat Alkalis is up 4%. You've got Kotak Parthiv from the real estate space up 2.4%. Remember, yesterday real estate and metals as a pack did well, so high beat up names started to perform. Polo Tires is also up 1.9% at 232. You've got Jindal Stainless, which is trading higher by 1.5%. Oberoi Realty yesterday was up closer to 4%. Today is up about 1.6% in early morning trade. Reliance Communications is also moved up. That's up closer to 1.5%. And then you've got the likes of a Reliance Naval, which is up 1.5% as well. 1% beverages, Berger Paints, Raymond's, 0.25% odd gains coming in there. Mid-cap space, though, the pressure is still more on the downside. So you are seeing a few stocks which are up, down and about in trade. So I want to quickly highlight them for you as well. Just quickly pulling up a few names on the downside. Okay.
Well, the losers, Devina, at the mid-cap end of the market, Voltas clearly right up there. So just pointing out one or two names before taking final thoughts from our technical experts. Bombay Dyeing is down about 5%, Reddington about 5%, Jet Airways 4.5%, Voltas 4.5%. Indigo, by the way, is at 826, so continues to grind lower. Repco Home Finance another 2.5% gone, Grove Finance another 2% gone, and Whirlpool about 1.5%. But clearly, Voltas, Whirlpools, and the consumer durable companies seem to be starting off on a slightly weak note. Nooresh, opening thoughts on the index and these consumer durable companies. What do you do here? Actually, let me first take that thought from Shrikant. Shrikant, what do you do here with these stocks? Because they've started off lower. I don't know if this is a knee-jerk reaction to the news or whether there could be some more downside and therefore worth a trade.
I think they have corrected already to the important support areas. I think we should look for adding good companies out of this basket because eventually, we have seen that after stabilizing, we always see first trend or first buying in all consumer durables and home appliances kind of companies. So there we feel that Havells is really looking good. Yes, Voltas is under severe pressure. I don't know why, but on weekly and monthly charts, if you see, the stock is forming continuously lower top, lower bottom kind of series. So it's it is better to stay away for the time being from Voltas. But yes, we like Whirlpool. We also like Havells India to buy at this price.
But Voltas, what levels do you see? I'm not saying that you will want to take a trade here, but it's lost 10% in the month gone by. Can it do further? Can it go down further?
I think, the downside next that we are seeing on charts and on long-term charts, somewhere around 500, the stock is having very good support. So below that, I'm not expecting. But at the same time, the way the overall formation is there, I think it is going to remain range bound. So it is better to buy if there is any deep, furthermore weakness in the short term.
Edelweiss now approaching 200, Shrikant?
Yeah, I think all these companies, they are just falling vertically, and they are falling mainly because of, I think, the way at valuation that they were quoting, and the way after this particular fall in all good companies, where the valuations was over and above the specific PE band. I think all these companies are under a lot of pressure, and for Edelweiss specifically, this stock has broken its important support area at 210, 220. So the next level watch out for is between 180, 190. So if there is a very short-term view, stay away from the stock. But if there is a medium to long-term view, and if somebody has bought this stock at higher levels, then it is better to hold on to the same, because in the long run, we are going to see one more bounce back, one more pullback rally from all these companies.
So what do the charts indicate? Does it indicate that Edelweiss could go up to 190, 180 as well, and then a bounce back?
Yeah, the fair chances are that. Fair chances, because currently they have broken their important support line on long-term charts. So it clearly shows that they are into downtrend, and whenever there is a downtrend in such kind of companies, we always see vertical sell-off, and it's they create panic or pressure at the lower end of the range.
Okay. Shrikant, good having you. Thank you so much for taking the time out and being with us today. Really appreciate your time.
Yeah.
That's the view from Shrikant Chouhan of Kotak. The markets are absolutely flat, but under pressure nevertheless the last few days. Good time to get in an eminent market voice. Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, joins us right now on the show. Mihir, so good having you. Thanks so much for taking the time out. This is Neeraj here. Good morning. What do you sense, Mihir? Not necessarily because of what's happening globally currently. I know crude is at a boil, etc. But almost everybody that we speak to seems to be saying that we have a mini, not a crisis really, but a worrisome situation of our own, which has enveloped the markets and which may not necessarily die down very, very soon. How are you approaching investing, considering all that's happening in the equity markets, considering all that's happening across the equity markets, the not a credit freeze really, but the problems around the credit markets too?
Yes, as you mentioned, oil is the single biggest factor impacting us. It's impacting the currency and overall sentiment. Moreover, since globally the dollar index is stronger, we are seeing continued outflows by FIIs from all emerging markets. So that, of course, is a headwind. And on top of that, as you did mention, we have a situation in the credit markets. I don't think it's a question of liquidity. Because of the couple of events that we saw in the NBFC space, downgrades, etc., there is a bit of a confidence sentiment issue, and to that extent, it's not something that can be not solved. We did see some good statements from the central bankers, from the government over the weekend, and those kind of efforts to soothe the markets need to be continued.
The RBI is saying that there is no systemic liquidity issues, specific issues, so they're not stepping in a big way. They've just released some statement today as well. Are you happy with all that's happening?
Yes. Only thing is more needs to be done because the credit markets in India are not that liquid, and if there is a little bit of a trust issue, then things can go downhill very fast, and that's why you need proactive action like the types that we have seen, maybe even more of that in the coming few days to basically bring the markets to some kind of equilibrium.
Mihir, good morning. Devina here. Just going back to your first answer. I mean, there are a lot of brokerages, which are suggesting that the fact that NBFCs have been a much higher percentage of the system credit growth over the last few years, a slowdown there will actually hurt macros in a meaningful way and then in turn hurt consumption. Do you feel that could be the case?
It could possibly, though one always wonders what comes first, whether demand comes first or the financing comes first. But any kind of liquidity squeeze in the financial sector obviously does impact growth. We have seen a huge amount of growth in the NBFC sector, and we need to understand the reasons behind it. That has happened because they addressed a gap in the financing market. Public sector banks, especially in the last few years, have been going slow on their lending because of the NPA issues. And there was a demand gap in various segments which the NBFCs were fulfilling. So I don't think demand is an issue. And as long as credit to these finance companies continue, I think growth should continue. I don't think there's a question of demand. There is pricing power in the system. And each NBFC has their own business model. So as long as the markets, the financing markets continue to function normally, irrespective of what the rates are, growth should continue.
For our markets, particularly on the index, the one-year forward PE is at highs of about 18 times. Is there a possibility of a PE de-rating which is likely to come about here?
Yes, though the overall PE probably may not even demonstrate the kind of polarization that we are seeing in the markets over the last few months. As we've discussed in the past, it's probably 8 or 9 stocks that are driving the Nifty in the last 6 months. If you look at the wider indices and even the mid-cap and small-cap indices, they are actually at their lows. So to that extent, the overall PE is a misnomer. There is a bunch of stocks which is very expensive, but there is a much larger universe of stocks that has been really beaten out of shape, and probably there is value emerging in those pockets.
Interesting, Mihir. Actually, I was going to ask that question. The divergence between the Nifty and the Nifty small cap is the highest in the YTD period than it has been since at least the data that we have calendar year 04 onwards. However, while there is value here, do you think there could be a protracted time correction in the small caps until things settle down? And if so, how long could that time correction last?
So it's a difficult one to predict the timing. If this credit market situation had not happened this month and the kind of panic that we have seen in the financials space had not happened this month, actually the Indian economy is showing signs of traction. So as long as we are able to get over it, probably we have already created a lot of value by marking down the mid caps and small caps over the last 6 months, and there is value available in this segment, I would say, as long as the Indian economy continues to grow at the rate at which it was already showing signs of in the last couple of months. We have seen some good data points on GDP growth, etc. And the crucial aspect, of course, was to see whether this good growth continues in the December and March quarter also. So I think consumption, etc., remains strong. It's an election year. Government will not let down on the revenue expenditure side. So to that extent, there are some levers for the economy to grow. And mid caps and small caps, because of their valuations having been marked down so much, have begun to show some interesting valuations.
while you have seen a markdown in valuations, are they still attractive enough? Because my conversation with a few market participants are of the view that while there has been a correction, it's not significant enough to probably warrant the trade-off between valuations and growth right now, and maybe an investment at this point in time.
Sure. You obviously need to look at it stock by stock, and I think like we talked about the large cap and mid cap broad divergence, even within mid caps probably there is a divergence between the top 50 which all the funds own and beyond the top 50 within the mid cap space. So I think there's a bit of a hard work to be done, but not impossible to find good value at these levels.
Mihir, the currency stays soft. If anything, almost all currency experts seem to believe that we might actually go down further, which means that the levels of 71, 72 or southwards of 70 seem to be here for the time being. Export-oriented sectors have had a bit of a rally already, maybe because of the rupee tailwind or maybe the general sentiment improving. Is there more here? The IT, the pharma companies, and maybe some of the other exporters as well?
Yes, so we have seen a lot of shift over the last 3 to 4 months into these segments, but it's probably a momentum trade. People are just taking a view based on the currency. I don't think it's a conviction call based on the long-term fundamentals of the IT sector, because fundamentally the sector is growing at about just about at double digits. So it's not in the scheme of things the fastest growing segment, but just because the currency view seems to be changing so rapidly, people are flocking to it, and we are also part of that flock. But if you were to ask me, if I were to look at the 5-year picture and predict that IT will be the best performing segment for 5 years, probably not. Though at this point in time we are tactically overweight, but it's not a segment in an economy like India which will be the fastest growing segment.
Mihir, have you spotted any outliers right now in this current correction that seem like a steady bet in terms of growth potential as well as a stock market return?
So we've been sticking to the private sector banks. Tactically, within the private sector banks, earlier we were overweight more on the retail oriented banks, but over the last few months we have within that private sector banking space also increased exposure to the corporate banks because of probably the NPAs having peaked out, and then leadership changes in a couple of the banks. So to that extent, we have been tactically churning the portfolio. We've increased exposure to IT, as I mentioned, to pharma and to metals. Again, more of a currency play, again a tactical play. I don't think it's a structural play. But broadly, consumption and government-led spending themes continue to be the focus.
All right. Mihir, thanks very much for joining in. Really appreciate you taking out the time and sharing your views with us here on this show. That's a quick market voice there. Looking at the indices now, the Sensex as well as the Nifty trading higher, but marginally, just about 0.1% or so on the Nifty as well as Sensex. Bank Nifty trading absolutely flat.
Well, on that note, let's take a break. On the other side, we take a look at the new roadmap in the making at HDFC Life with the newly appointed Managing Director and CEO, Vibha Padalkar.
Good news, guys. Got a promotion and a damn good raise.
Congrats, beta.
Congrats, मेरी तरफ से भी.
From mama too.
वाह, raise? अब तो इंश्योरेंस पॉलिसी ले ले.
इंश्योरेंस? कौन सी कंपनी से लूं?
सोचना क्या? चूज वही जिस पर हो पूरा भरोसा.
वीरू, go for convenience. My company is online, quick and simple.
बेटा, but पॉलिसी समझाएगा कौन?
वेबसाइट पे सब है पापा. I can even call and ask.
क्लेम सेटलमेंट का रेशो क्या है? मेरी कंपनी का 98% से ज्यादा है.
That's good, but आज की generation wants everything online. Easy premium payment options, loan facilities, और wide range of products.
अरे पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना सेम चॉइस LIC.
LIC ट्रेंडिंग विद टाइम्स 62 सालों से हर जनरेशन की पसंद.
When I started juicing to bounce back from a serious injury, I had no idea that it would turn into a passion, that would turn into a brand that provides healthy choices to millions of consumers. Today, my brand is a household name. I am Anuj Rakhian, and my story is a clean and a flavorful one. I'm the raw pressery guy, and I'm here to tell you my story only on Aegon's of Business.
Aegon's of Business never stop. Only on Bloomberg Quint.
Welcome back to Indian Open right here on Bloomberg Quint. Markets flattish in trade. HDFC Life has a new person in the corner office, and the numbers do tend to favor the largest private sector life insurer as well. Can the rising competition from newer players and newer distributors who typically undercut on premiums to capture market share upset the apple cart, or will the leaders continue to become larger? What is the new CEO's roadmap to protect what is their own territory? Let's ask the person herself. Ms. Vibha Padalkar, the new MD and CEO, joins us right now on the show. Ms. Padalkar, good having you. Thanks so much for taking the time out. You know, you have a very strong legacy to continue. We were looking at your numbers, highest VNB margins as of Q1 FY19, the net profit 5-year CAGR, highest amongst the private sector players, highest valuations as well. And maybe you need to do a lot more to live up to those two. How do you see and how do you set the roadmap as you take over from Amitabh Chaudhary in about a couple of months' time from now?
So I have already taken over. But in terms of the overall growth, what we have in terms of penetration in India today is woefully inadequate. We used to be a lot higher, about 4.6%. That's gone down to 2.8% as an industry. So really, rather than worrying about growth, because that is inevitable in India, wherein both in terms of protection, so the protection gap is 92%, which means out of every 100 rupees what people have overall as protection is only 8 rupees. Also aging population, slowly but surely, so we will have double the number of senior citizens in about 20 years. So that itself shows that people under the age group of 20 is going down, over the age group of 65 is steadily increasing. So the need for 3 tenets of protection, which is mortality, morbidity, as well as longevity, is certainly something that would be required, and we would be able to come up with innovative products, withhold in terms of our market share on our existing distributors, as well as tie up with new distributors, which is something that we have been very confidently been down that path, and having tied up with 163 distributors, traditional distributors, as of the end of the first quarter. So really continuing on that journey that we set out about 5-6 years ago.
Interesting. So, I take on board that point. I think 163 bank assurance partnerships, 26 non-traditional partnerships as well. Is this a sign of things to come, or would you believe that going digital, digitization, and getting people to invest direct is the bigger trigger of growth for you as a company? Or not just necessarily over the next 2 quarters, but let's say over the next 2 or 3 or 5 years?
The way we see in terms of how our distributor shares pan out, we would like each one of the significant contributors to grow in a manner wherein it fulfills the potential of that particular channel. So even the ones that are traditional in nature, like our agency channel, has been tracking growth of about 25 to 30%. No reason to believe that will not continue, especially given that we've succeeded in making our agency channel perhaps the most profitable at company level margins. Same thing with our direct channel, wherein the share of our direct channel has gone up very significantly. It used to be around 10-11%, gone up to 19%. So have seen some addition of partners there, including our own indigenous upselling to our existing customers, both in terms of online as well as branch walk-ins and other modes of touch points. And also the new tie-ups. So new tie-ups will also continue, both in terms of new ecosystems like you mentioned, all the fintech companies, the cab aggregator companies, companies that sell online. These are all the new ecosystems. So really it is a multi-pronged approach as against just one or the other.
Fair call. While we are on that topic, just a question that seems to be bothering select sectors, and your view out here would be really welcome. HDFC Bank opening up the access to some of your competitors as well. Now, people are undecided. There are some who believe this could be a possible long-term negative for an HDFC Life. Would you agree?
I think, like I mentioned earlier, first of all, this open architecture was something that HDFC Bank had communicated for a very long time. So this news really has been a factored in news, and which is why our quest to tie up with several other partners as well in an open architecture model, and we have been very successful in getting to the 163 number plus the 26 in the non-traditional, and we would like to believe that in the private sector we are perhaps right up there in terms of number of partnerships that we have, and this is just the beginning. So 9 out of 10 small finance banks that we have tied up with. We have tied up with both the banks that have got the recent banking license. Every marquee NBFC that has agreed to open up, we have tied up with. So really it is a question of how do we expand our distribution as against have all our eggs in one basket. At the same time, we want to offer HDFC Bank the best value proposition, and this isn't really only after multi-tie scenario happened. It was all along, wherein we would like to believe that we gave them the best value proposition in all aspects, including in terms of the technology focus that they've been having recently in the last maybe 2-3 years. And so that will continue, and what might be perceived as a disadvantage of multi-tie is also our advantage, as is evidenced by our recent win with Vijaya Bank, for example. And we would like to believe that that trend of also making inroads into tie-ups with other public sector banks will continue. Sheer strength of what we can do on the bank assurance, and we are perhaps the market leaders in that space, would mean that it is a no-brainer for even other banks to, as and when they open up to multi-tie, that for them to choose us as one of the partners.
Which I don't think anybody would contest. But Ms. Padalkar, a small follow-up to that. You mentioned that you would continue to grow through all kinds of associations and partnerships as well. Let's assume a 5-year scenario. Would you believe that the nature of growth would entail expenses which are higher? Yes, I know expenses go up as more tie-ups, etc. happen, but would the rate of growth of expenses in order to facilitate these tie-ups and nurture them over a period of time be slightly more than the growth that they bring in the short term? And by short term, I mean the next 3 or 5 years. And therefore, is it possible that while we see growth grow, we might see expenses grow at a slightly faster clip over the course of the next 5 years?
So what you're saying is right from an Indian GAAP perspective, because Indian GAAP as it stands today does not allow us to straight line the expenses. And insurance is a long tenured product. So if I were to straighten the expenses like it is in under some of the other accounting standards like US GAAP or IFRS to some extent, then those expenses would get straight lined. But because Indian GAAP as of today does not allow us to do that, so in a high growth scenario, expenses will have to be booked to the P&L as they are incurred. And so while the expenses, it is very possible that expenses might grow at a slightly higher clip as we tie up with more partnerships. But what you will certainly see is that the post over a new business margin would continue on a smooth upward curve. And that is really what is important, because the new business margins take into account that the expenses incurred, all things being equal, would be straight lined and the profits would flow through. So that's something, and the fact that we ended at 24.2% new business margin in the first quarter, we would like to believe our industry leading margins, and these are fully factored in margin with all expenses being booked of every kind. There's not a single rupee that is not reflected in that margin. So we would like to believe that while there would be investments that are required to be made for growth, both of a here and now operating expense as well as capital expenditure on technology, but new business margins would continue on a smooth upward trajectory.
Okay, just a two-part follow-up on that. One, does this have a sweet spot or an inflection point of sorts wherein you keep on investing and the expenses would grow at a particular rate, even as per Indian GAAP, for example, for a particular period of time, and then the revenue growth has such a nice smooth up curve that it takes care of the growth in expenses as well? And part two of my question, you mentioned about these margins looking up at 24% in quarter one. Is there scope to take them higher in the near term itself?
So as far as the expenses, yes, with scale, the level of expense growth will come off. But having said that, HDFC Life, our P&L reflects every rupee, like I said, unlike in a lot of other life insurance companies wherein there might have been some structuring that is done at a shareholder level or some other kind of alignment between your biggest distributor and the life insurance company, etc. Which so the life insurance expenses don't fully reflect what market commercials demand, and hence HDFC Life might take a little bit longer to taper off on the expenses. Also, tapering off on expenses isn't too difficult in life insurance industry. At one point in time, we were down to 10.2%, and getting to high single digits would not have been difficult, but that would have meant not investing in all the things that we are doing, whether it is in the field of analytics, robotics, in terms of exploiting the power of fintech companies, in terms of being able to enable our agents to go to the customer to service. So the entire gamut, when we would like to believe we are again being the market leaders, would not have been possible had we taken a very here and now quarter-on-quarter view to say what do we do on expenses. So your second question on the margins, margins are a function of what we sell, and with product innovation, that again, that's a focus that we've been doing on the three tenets of protection. If we continue to focus on that, and again, that's something that we have been coming out with a lot of innovative products, especially a breakthrough deferred annuity product that we launched recently, about a quarter back. Is something that would help us to expand margins. So the focus for us is, along with cost efficiency, to also see how we can exploit or take advantage of pools of profitability which are up to now relatively untapped. And we did that when we looked at our credit protect segment of covering or insuring loans that are taken by customers. We looked at our pure term online proposition. We looked at how do we sell the likes of cancer care. First of all, conceptualize, manufacture, and then sell the likes of cancer care, cardiac care, which are lifestyle illnesses, and now finally the deferred annuity product that I just mentioned. So that also will mean margin expansion and will help in that.
Interesting. But wouldn't the rest of the industry catch up with these products very, very quickly? Typically, how long would a first mover advantage be for you, one on the growth, two on the help that or the aid that does to your margins?
Absolutely right. So we have been market leaders in innovation, and both, like I said, in what we sell and how we sell, and there is a catch up. So as soon as things become public, our management mind share has already moved to the 10 things that we are investing in at any point in time in terms of big bets. So yes, we have to continue to run to stay in the same place, and that is inevitable in an industry that really does not have very much of trademark or copyright. Products can be copied, but I think the brand also helps in a big manner. So it's not just the same product offering, but it is the trust. Insurance ultimately tends to be an emotional buy and lesser of a cerebral buy. So it's an entire package when you go with an offering.
Interesting. Is cross-selling now becoming bigger and bigger for you? I mean, a lot of other companies in other sectors, I mean, you know, the Bajaj Finance is a classic example of they saying that we are getting more and more from our existing customers. Now, I know that I read up one statistic which said that the cross-sale base for you, policies from existing group customers to total new individual policies has increased to about 7.7% from 1.6% in FY15. Maybe my numbers are a bit off here and there. But what's the scope of this improving further? And I'm guessing that would be a lot more cost effective for you as a company.
It is, and also a happy customer is a customer who will, the propensity to buy is that much more. So you're absolutely right in terms of the numbers that you mentioned on our ability to upsell to our credit protect customers. So those customers might not have had any relationship with any of the HDFC group companies, and yet we are able to upsell to the customer. But it's not just upsell, it is also the use of analytics, it's the use of a lot of algos to come to sensibly upsell as against just carpet bombing. We also do a lot of nudges, maybe 3 or 4 nudges before the customer realizes the need to protect in some manner. And when the customer finally buys, he or she thinks that it is their decision to have done that. So using various modes in which for us to upsell to the customer. So our customer base is there. We are also working on a 360-degree view of the customer. This also means that when a customer enters or transacts with any of our touch points, we are able to know the temperature of the customer. Is there a lot of angst? Is this a happy customer? Has he or she moved in terms of their own personal situation? What are they looking for? And also through the new ecosystems for us to get a sense as to what is the DNA of the customer now as against when we sold the first policy. So a lot of these touch points which we are intensely working on to ensure that we upsell or cross-sell the right product at the right life cycle for the customer.
Interesting. One thing that I hear a few skeptics, I mean, purely from an investing perspective, I'm talking about, Ms. Padalkar, people who are trying to invest into the life insurance space talk about one factor which is not turning out to be the best for the space in general, and that is the 61-month persistency ratio. For you as well, it may have gone up a little bit in Q1, but by and large, if I look at the trend for the last 3 or 4 years, I think for you as well, the 61 persistency ratio would have come up. It's come off for the industry at large too. How valid is this concern? Because people may be coming in for year 1, maybe year 2, so the 13-month might be looking okay, the next period might be looking okay, but it's not necessarily lasting for 5 years. How realistic is this concern?
It is factually correct because that's what our 61st month persistency shows, especially for the last year in FY18. That particular cohort, which is what we sold 5 years ago, had started off at a disadvantage, wherein that the 13-month persistency of that cohort, which is today at 61st month, was at 69%. So we have been at a disadvantage, started off at a handicap, and since then we have been collecting at over 80% year on year. So we have stemmed what we started off at a disadvantage. However, the trends that we are seeing in terms of the next cohort, which have completed 4 years, they are trending a lot better than these numbers. So once this particular cohort, which is at the 61st month, exits our system, the next cohort that comes up will start showing signs of improvement. A lot of it depends on the product architecture. There are very little exit barriers today, especially when you compare with the likes of some of the other economies like China. And so it is a struggle to withhold, especially in the unit link space, lesser in the non-participating and participating product space, but in the unit link space there is a 5-year lock-in. So there's an event that happens which perhaps nudges the customer to think as to do I want to continue or not, and exit barriers, like I said, even during the 5 years are woefully inadequate. And so some of these structural changes, if they are done even at the fringes, could help us get to above 90% on the 13-month persistency, and consequently get the 61st month persistency significantly higher. So some of it is structural, but one would see, not just for us, but I would also hazard a guess that industry as a whole is largely focused on getting persistency right, a lot more that they're aware today of the impact of a happy customer as well as impact on our overall profitability if we get that right. So there is a lot of focus happening.
Maybe valuation as well. But just wondering, so when does this next cohort, I mean, I don't know if we can time it, but do you reckon FY19 onwards, you will have a much more stable and a higher 61-month persistency ratio, or would it get pushed from FY20 onwards?
No, from FY19, the trend should start looking positive. It'll certainly improve FY20, but in FY19, there's a mid-year impact. So the full impact of that would start panning out from FY20, but FY19 also you should start seeing green shoots in terms of the 61st month persistency heading upward.
I read somewhere, Ms. Padalkar, that you also as a company are focusing a lot more on single premiums now. Is that true, and the rationale thereof?
So it's lesser of focusing on single premium as a strategy. I think what we are focusing definitely, they are a couple of things. One is on protection of both mortality as well as longevity. Mortality protection is which causes single premium to look a lot higher is in the space of Credit Protect, which is on a single premium architecture. So the way it works is if a person takes a loan, then the loan is covered. It's a single premium that's paid to us, and we cover the tenure of the loan. In terms of single premium in the sense of in the non-participating space, which is the annuity and deferred annuity space, which looks at protecting longevity risk of people living too long. So there again it is a single premium. So we receive a single premium and we pay out an annuity until the person is alive, or several variants of whether he's alive, his spouse is alive, etc. Again, on deferred annuity product, which I mentioned that we launched recently, that too is single premium, and we cover after a deferment period based on what the policyholder chooses. The annuity starts after a few years. So that too is single premium. So it appears that it is a single premium focus, but that's really an outcome of the protection strategy that we are focused on.
Okay, one last question, Ms. Padalkar, before we wrap up this interaction. You know, when you look at some of the other industries, autos, for example, the largest player is only looking to get larger. It's not that the 3 or 4 larger players are gaining necessarily at the expense of some of the smaller players, or the private players at the expense of the publicly listed players as well. How do you view this industry growing the next 5 years? Would it be the private insurers gaining over, or the large private insurers gaining over the public insurer and the smaller players? Or would it also involve you as one of the leaders gaining market share over the other large private players as well?
I think both, because like I mentioned, talking about us, we should continue to gain market share, because on the basis of us expanding our distributor tie-ups, our continued foray into the uncharted territory of tying up into new ecosystem, and as they grow, we piggyback on the growth, as well as focusing on expanding the product offerings as against just talking about the 3 traditional products, which are unit-linked, participating, non-participating. So coming up with product innovation based on changing needs of the Indian customer, including lifestyle-related changes, socio-economic changes, etc. As far as the overall growth of the industry is concerned, no reason to believe, absolutely no reason to believe why life insurance industry, which anyway has gone down in terms of penetration, like I mentioned, to now very low numbers of 2.8% from a high of 4.6%. means that we can at least go back to the levels that we ourselves were. Also, when you read it in conjunction with rising per capita income, going similar footsteps, the way China has increased, also the relative disadvantage that some of the other financial services products are currently going through, as well as say where interest rates are headed. So for example, bank fixed deposits would be significantly less attractive than they might have been maybe 4 or 5 years ago, means that there's no reason to believe that the savings that are coming into, first of all, into financial savings pool, and thereafter what is being attracted by the insurance industry should not go up. So the overall macro is very, very well suited to the growth of Indian life insurance industry.
Yeah, I wish you all the best for leading this growth in your new role. Thank you so much, Ms. Padalkar, for talking to us. Look forward to talk to you post some of your quarterly numbers as well. Well, that's Vibha Padalkar, the new person in the corner office at HDFC Life. But we come to the end of this leg of Indian Open at least. The market's lying absolutely flat, but it's the expiry day. So very important to monitor what's happening on the FNO show. That's coming up next. Stay tuned to Bloomberg Quint Live.